Welcome to the Reboot Chronicles, connecting you to the world's top leaders and CEOs rebooting their organizations and themselves with revealing stories to help you prosper in unprecedented times. I'm your host, Dean DeBias, and as a serial CEO who's led dozens of companies that created thousands of jobs and billions in revenue, my passion is uncovering powerful lessons that can inspire you to reboot your organization, your career, and your life. Listen and subscribe wherever you get podcasts or at rebootchronicles.com. I'd like to welcome a powerhouse in the boardroom and on the basketball court, Dave Butler, the co-CEO of Dimensional Fund Advisors. Dave has had a wild ride of a career, which started on the basketball court, a Rhodes Scholar candidate, Pac-12 Basketball Hall of Honor recipient. He was an All-American at UC Berkeley, drafted to Boston Celtics. Though his NBA career was sidelined by a player strike and an injury, Dave pivoted with purpose with a series of serendipitous events that led him on a remarkable reboot journey. Dave's helped grow Dimensional assets under management from about $10 billion to $850 billion and counting, becoming a leading global financial services group. They've been rebooting the financial advice model. They've built a hyper-successful business that specializes in research-based systematic investment approach rather than just guessing what's next in hot stocks. He's not only a leader in finance, but also a passionate advocate of redefining wealth management and investor experiences with a rare mix of discipline, vision, and heart, pretty much in everything he does. So let's dive in with the mindset, milestones, and missions of a leader who's helped transform how the world invests. Dave, it's good to see you.
Great to see you, Dean. Thank you.
You are the perfect reboot, teaching people, you can have many lives. And it's something that I talk about a lot with, coaching CEOs and talking to students at Kellogg Northwestern and just everyone is like, it's just because you start out in one direction, that doesn't mean you can't switch. So we'll love to hear that whole journey, but we have more hard-hitting questions for you to start out with, like how tall are you?
Well, as I mentioned, I'm somewhere between 6'6" and 6'10" on various publications over the years, but I would guess I'm 6'8" and shrinking, I think, as I get a little bit older.
Those of you not on the video feed, he barely fits in the screen where I have plenty of room. And you grew up in a basketball family, and didn't your brother play with the Knicks as well?
Yeah, so my younger brother, Greg, he's a 7-footer, and he played at Stanford.
Whoa.
I played at Cal. We were rivals in college. We actually guarded one another, which was very interesting for my parents. And then just in my local, it was a great team. Yeah, in the local high school that I played at, one of my power forward next to me was a guy named Jay Billis, who's now on ESPN, and he's 6'8", and I'm 6'8", and Greg's 7 feet. So from a high school basketball perspective, we're a pretty big team.
Yeah, it's amazing. The from your journey, I won't tell it because I'll let you tell it, of course. But just from what I know, it's fascinating. He went from sports, a couple other things, became a teacher for a while, and then kind of pivoted into financial services, somewhat serendipitously, and now obviously the CEO. What did this journey teach you? What was that all like?
Yeah, it's been a fun journey. I mean, my dad, looking back, was hyper focused on academics, so he really liked the idea of me and my brothers getting to good colleges, and then basketball was something we obviously grew into. We got tall, and we were pretty good players, so we were able to use that as a lever to get into schools like Cal and to Stanford. So it's been a big part of our existence. We wrestled, we fought, we played one-on-one in the front driveway, every day, 4 hours a day. I have an older brother as well, so we were all about the same size, even though we were about a year and a half apart each. And we competed all day long, and so that was my childhood growing up, and that kind of really laid the foundation for my athletic endeavors over the years. Yeah,
and then your journey into the business world was. It wasn't direct. It was a little bit indirect. How'd that go?
Yeah. I played at Cal for 5 years and got drafted by the Celtics, as I think you had mentioned. And when I came out of school and got ready for the camp in Boston, turned out that the NBA had a strike that year. So I wasn't allowed to go to camp. Ended up pivoting and going to Europe to play my first year. I played in Istanbul, Turkey. and that was quite an experience. Came back the following year, played in Japan. Along the way, I'd actually had torn up my calf, my end of my season in Istanbul.
Oops.
So I was kind of recognizing that my basketball career wasn't going in the direction I wanted it to. So athletically, I wasn't quite the same player. After that first year in Istanbul, I played a year in Japan, went back to Berkeley, got my MBA, finished that up. And then I just had one last run in Birmingham, England. I thought that'd be fun just to finish off my career. I wasn't thinking NBA at that point in time, but I thought to get over there, I'd play a little ball. I didn't want the dream to end, if you will. And finish up my last couple months in basketball in England.
Wow. I mean, so you really gave it your all. A lot of new recruits then, because the strike hit and they were new, they tried it for a little bit in Europe, and then they're like, forget it, they quit. So you didn't do that. You actually gave it your best shot. You're also you're probably the smartest guy on the team too. It's like smarty pants getting an MBA here.
Yeah, well, it was one of those where I hurt my knee during my college basketball career, so I had an extra year to play, and I had to take a grad study at that point in time. So I decided to get my MBA because my undergrad was in finance as well. So that was a natural extension.
Yep.
But as when I was finishing up the MBA, I was interviewing with a number of investment banks in New York, and I still had the passion for basketball. I wanted to finish it out, make sure I didn't leave anything on the table, if you will. And so I interviewed with a number of big firms, and then I went off to Europe. And about 2 months into the season, one of those firms called me and said, "Hey, we want to offer you a job." And that was on a Saturday afternoon. I went into the coach and just said, "Look, this is the dream from a finance perspective to go be on Wall Street, and my career feels like it's over, and I'm going to try to take that job." And I basically got on a flight on Sunday afternoon, flew into New York, as I've told people, got to my brother's apartment Sunday night. He's 7 feet. I borrowed a suit from him. Went into the office on Monday morning. That was the start of my career. So people often ask about the reboot or the transition, and that's what it was. It was about 24 hours from playing in a game on Friday night to starting at the big investment bank on Monday morning.
Yeah, it's a good thing the suit fit. And what was that like? A lot of my ex students go to they go into investment banking, and they find it a bit of a heartless place, and end up kind of pivoting into other things. What would you end up doing?
Yeah, I think that was kind of my reaction too. I mean, I did it for about 3.5 years, and didn't love it. Wasn't passionate about it, and got to the point where I felt I wanted to pivot completely. I still had the passion for basketball. I have a passion for education and teaching, and so I decided I was going to go back to California and go be a teacher, high school teacher and basketball coach, and that was my game plan.
Wow.
So as I was contemplating that, I was sitting on the desk in New York and found an ad in the Wall Street Journal, 17th page, bottom right-hand corner, and it said money manager, Santa Monica, California. I like the 3 words, Santa Monica, California, being a California kid and a beach kid. And so I sent a resume in just, randomly, and it turned out to be Dimensional, and I was offered an interview over Christmas break, went into the offices here in Santa Monica and met some fabulous, amazing people, including a Nobel Prize winner, Merton Miller.
Yep.
I had lunch with Merton Miller, and
famous guy.
Walked away from that. Yeah, I walked away from that, and I just thought, this place seems different. It seems very oriented around the client, and it had this amazing foundation from an investment perspective around this idea of efficient markets,
right,
and markets in equilibrium. And that was really the story that really caught my attention and made me kind of pivot again away from teaching and going back to finance. Yeah.
So did you ever teach for a while?
Never did full time. Yeah. I've substituted a couple of times.
Have you been
I don't think I'd be a good teacher.
I've got some guest lecturing you can do for me if you have time.
Okay.
You just kind of threw in a comment there. Hey, interviewed with the Nobel Prize winner. Didn't your firm have 7 of them?
Yeah, we over the years we've been associated with a lot of Nobel Prize winners. So even today, I think we have 3 active Nobel Prize winners, two on our boards, and one that's a consultant to the firm. So you walk into Dimensional as a firm and you just recognize the academic pedigree here is just incredible.
Yeah.
I think we have 20 plus PhDs in our research department. We have, as you said, 7 Nobel Prize winners we worked with through the years. It's a pretty engaging and pretty amazing place, and you definitely walk in each day and are amazed by what you learn and the intellect that's kind of floating around the hallways. So
you guys are known.
These folks are actively involved too. They're not just names. They're actually in meetings. I had a board meeting yesterday with one of those Nobel Prize winners, Gene Fama, was in the room yesterday. So it's great to know them, great to see them. They're amazing people, very modest, but very, very smart. And they've really been the foundation for the firm over the last 40 years.
You've got a lot of brainiacs working there too. I think So what's the secret sauce? How have you guys kind of outpaced the market and changed that model?
Well, I think, each of the founders were really the folks, when you go back to the 1960s, these guys, most of them at University of Chicago, some at MIT, they started looking at data on capital market data and stock market data.
Yeah, they were major quant guys. I remember that.
Major smart guys. And they started looking at this question about market efficiency. And that question led to were managers able to actually outperform the market by picking stocks, for instance? And the answer was a clear no. And so that really led to the introduction of index funds, which we're all aware of the term index funds, and index funds are now over half of the market, the invested market here in the U.S. But indexing at the time in the early 1970s was very different. Was considered to be non-American, considered not to be competitive, and so forth. But the founders here at Dimensional were the folks that actually started with the first index funds. And the idea was to be completely diversified, be low cost, be tax efficient, and those investments over time would do as well or better than the actively managed stock picking funds that were out there at the time, and where people were paying a very, very high fee for that. So there's a big transition in the early 70s and in the early 80s. And then Dimensional was launched in 1981 and really was built around this idea of these premiums in the market around small cap stocks and value stocks, where those areas of the markets actually outperformed and gave a higher return than the standard stock market. So Dimensional really built a business around those two concepts, implementing daily, trading in a really efficient way, and then recognizing that there's areas of the market that have higher returns over time.
Yeah, those are the 3 pillars. What do you mean by low cost fees?
Yeah, low cost fees, exactly. So when you think about, when I started in the late 1980s, an average fee for an actively managed fund, a stock picking fund, would be 1.5%. And you look at index funds now; they're kind of on the order of about 1/10 of that, so about 15 basis points on average. Yep. So the fees come way down, the diversification goes way up, to tax efficiency goes way up, and I think the end investor impact and investor experience goes way up, which is really, I think, what attracted me to the firm.
Yeah.
32 years ago.
Acting more like a fiduciary. Now everyone's using that in their ads, of course. But didn't Charles Schwab do that for the retail sector? Similar.
Yeah, Schwab was a custodial platform that many of these RAs, these advisors, moved over to start their businesses. So, the real, on the advice side, on the wealth management side, it was really about redefining investment advice. And when I started in my early days, it was the environment for investment advice was transactions. Yep. And the idea was to get you excited about a stock or about the direction of the market and get you to transact. And if you transacted, then there's a commission that would come to me as the broker.
Good or bad, right?
And the more you transacted, the more money I made as a broker. So that was the old model of advice. And what we try to do here, and there's many pioneers involved in this kind of movement towards a fiduciary platform, was to move people towards a redefinition of investment advice, where the advice was in the best interest of the client. The advice was transparent. The fees were transparent. And we thought that sort of a platform was one that would make sense for the end client. And we thought that many advisors who actually took that model and worked that model with clients, those advisors would be very, very successful doing it. And that's exactly what's happened. So you had mentioned we went from 10 billion to 850 billion. I think 650 billion of that is from financial advisors who are in this fiduciary investment advisor space, where really it is the client who's at the top of the stack and looked upon in a fiduciary kind of responsibility way.
Oh,
and that's one that we've really we worked a lot with RAs over the years to deliver that kind of client experience.
so you rebooted the business model in a couple of ways too, because you're kind of a B to B to C model. So you've got people up here who have clients. You're actually managing the money for them. That's
right.
That's remarkable.
Yeah. That is the stack.
I missed that part. Wow.
It's a client. The advisor is working on behalf of the client, and then we are one of many money managers, and we're one of many custodians that work to get the advisor to consider us as an option for their client. So they're working on behalf of the client and working as their kind of their coach, if you will.
Yeah,
and it makes a lot of sense.
Lower cost acquisition strategy for you too. Now, you probably got laughed at way back when. I mean, the Wolf of Wall Street movie comes to mind for the younger audience. They remember at least seeing the movie. Weren't around, but they probably said, "Oh, you're not going to make as much money," but in the end, you actually are making more money than the old model probably ever did.
Yeah, I think that's right. I was telling the story the other day that I was looking through my garage and I had a stack or box of old materials, and one of them was a trade ticket when I was at that investment bank, and I had paid a $500 commission on a $10,000 stock trade. So that was 5%.
Wow!
And that was just to buy the stock. Yep. So when I sold it, I would pay another 5%. So when you think about that, the old market was a lot of transactions, high commission, 10%. And the ability for an investor to really have a great experience in that environment was very, very difficult. So, the environment was built around emotions and getting you or me as an emotional investor to be greedy or fearful, and then to trade on that emotion.
Yeah,
and the more I got to trade on that emotion, the more money as a broker that I would make. So that was the old model, and this redefinition of investment advice really shifted that model away from transactions towards a fiduciary model that was really about the client.
Yeah, you guys were way ahead of the curve with data scientists, which we call them now. And let's go into that in 1 second. Talk about AI, because a lot of these little guys are catching up with you with technology. Before that, though, you were on. I think you ran the opening bell a few days ago, and we're talking about this new movie that's out. And I just thought it'd be nice to talk about it. Tune Out the Noise. So what's that all about?
Yeah, the movie's Tune Out the Noise, and the director is a documentary named Errol Morris, who won Academy Award. Yeah, he won an Academy Award for his work with Senator McNamara, who was a part of the Vietnam War.
Right.
It was The Fog of War, I think was the name of that documentary. But this one's about what I described earlier. So it takes this group of people that were really at the heart of this movement, where trillions of dollars have moved towards this index or passive index type investing approach. And he does a great job of just interviewing those folks and understanding better what happened in the 60s and 70s. In the 60s, they got a hold of really powerful computers, and they were able to look at data, and people had never really understood what the stock market had given in terms of total return, for instance. So people didn't know that you basically got 10% from the stock market if you invested over the prior 80 years. And so once they were able to actually understand that, and then understand that, as I mentioned before, that actively managed portfolios, stock picking portfolios, weren't able to outperform that standard 10%, then it made total sense to move into a portfolio or develop a portfolio that would be an index portfolio, which would buy every stock in the market, be diversified, and be a buy and hold type portfolio. So that was the essence and the foundation of indexing. And that was in the early 70s. So the founders of Dimensional, David Booth, Mac McCown, Gene Fama, those folks were all involved in that movement towards this indexing type, indexing revolution. And that's what the story really talks about. It talks about that evolution, the evolution, as we said, around advice and how advice is given in the U.S., going from a commission-based advice to fiduciary-based, transparent, fee-based advice. And so those two big shifts have been really, really dramatic changes for the investor in the U.S. and really around the globe. And that's been a really exciting an outcome. And Dimensional as a firm has just been part of that process from day one.
Yep.
And so Errol Morris saw this story. He thought it was a really cool story. He thought he needed to tell it in a documentary type of a format, and that's the movie. So it's gotten 15 million views on YouTube. It's had 600,000 full views where people have watched the entire movie from front to end, and you can see it on YouTube.
That's good now for a documentary. Yeah, we'll obviously push it with this episode as well. That must have been fun being involved in that. A lot of interesting history. So I mentioned you guys were ahead of the curve now with the convergence of machine learning and artificial intelligence and the hype of AI. There's, I'll just say tons, but probably 100 fintech-ish types of companies attacking every piece and bit of the business models that we're talking about here. And a few of them, the big new fintech guys, the unicorns have been on the show, and everything from retail to loans to, more arbitrage and B2B stuff like you guys. So I guess two questions. How do you, as a firm, evolve with the next generation technology so you don't get kind of Ubered before, somebody Kodaks you, or you Uber yourself before you get Kodaked, as we like to say. And and secondly, really, what do you think about a lot of these up and coming AI-enabled platforms for investors?
Oh yeah, it's important. AI is an important subject, an important topic. We certainly use a lot of different applications in the business. We use it, in terms of processing information and in terms of kind of working through the business as you would assume. What we don't do is we don't use it in terms of projecting markets, projecting directions of stock selection, those types of things. We do think the market is like the ultimate AI, right? It's an information processing machine, and so this concept of market equilibrium or market efficiency is really built around the idea that the market price reflects information in a real immediate fashion, and that market is really good at predicting price. And so we don't try to outpredict the market. We basically take the market prices as they are. And then, as I said, we try to implement on a daily basis, make sure we minimize frictions. We target certain premiums in certain areas of the market that have higher returns. And then we have a very diversified, tax-efficient buy and hold portfolio. So from that perspective, we think that view is the right one, and we think it's going to continue to be the good view going forward.
And do you see it a limit? So a lot of financial, let's just call them the 9 big dog banks. There's a lot of people attacking little pieces of their business, including the investment banking stack and the whatever you call it, the investor relations side and the retail side. Where do you think this market's going in the next 5 years or so? The services market you're in, I mean, maybe it's bracketed by, high net worth and maybe a little less, but it seems like there's a lot of turmoil in the retail side right now.
Yeah. There's going to be more efficiency, and the AI tools are going to make things more efficient. As you know, you can write newsletters and you can do presentations, with AI tools and so forth. So there's going to be efficiency that comes from it. I think what we'll see is we'll continue to see more focus on the retail investor. There's a recognition that there's a lot of investors now that are getting more participating in the market more than they ever have, and so I think there's a focus on those clients and making sure that that the tools are out there for them to actually succeed as investors. So what I always think is the kind of the buzzword is customization. Efficiency and technology have made it very, very easy for asset managers, custodians, and so forth to go down market and to deliver the types of services that maybe were delivered to very, very high net worth clients. Those can be delivered to clients at a much, much lower level and at much larger scale. So customizing things around tax, around estate plans, around development of college plans, charitable giving, all of those things are the things that advisors now are working very hard on, and then doing significant work with clients. So it's no longer just hey, Dean, here's a stock you ought to buy.
Yeah.
Again, that was the old investment advice. Today's investment advice is, hey, Dean, let's sit down. Let's talk about your family. Let's talk about your charitable aspirations. Let's talk about how your estate plan should look. Let's talk about your wills, your trusts, making sure that all of that stuff is in order. And then from a vehicle perspective, let's do it in the most efficient way possible, which is, where I think from like Dimensional comes in, low cost, diversified, tax efficient, properly targeted around the globe in terms of areas of the market that have higher returns. And so you've got an engine of investment return there that sits at the base. And then you've got all these other aspects that the advisor delivers on that allows them to be holistic around that offering, that wealth offering to clients. So all of that has come downstream, and we're able to deliver that to a much broader base and much a lower asset type of clients than we have in the past, which is exciting.
You had mentioned the power of 7. What is that?
Power 7 is just this idea that if you get 10% return on which is what the 100-year stock market return has been, if you get 10% for 7 years, your money is going to double. So what I like to tell young people, my son's 22, if he has, pick the number $100,000 at 22, if he gets 10% return and he stays, again, diversified and, tax efficient, all that stuff, and minimizes friction, that $100,000 at 22 is going to turn to $200,000 at 29. It's going to turn into $400,000 at 36. It's going to turn into $800,000 at 43. It's going to turn into 1.6 million at 50. It's going to be 3.2 million at 57. And when he retires at 64, it's going to be $6.5 million. And that's the power of 7. So this idea that if you can be in markets, you can be diversified, you can hold on, not allow emotion, which is fear and greed, to make you move in and out of the market. Don't be afraid of tariffs or what's going to happen in the market next week or what's happening with the Middle East, whatever it might be. If you stay in the markets, if you're a student of the global capital markets, you'll see that global markets return about 10%. But the key is most people don't get that 10% because they aren't able to minimize the emotion and stay in the market over time. So advisors come into that discipline role. They come in as coaches and teachers and trainers, if you will, and they help clients maintain that discipline. But if you're able to maintain the discipline for 10, 20, 30, 40 years, if you're a young investor, you can do that kind of math, and those kind of returns are going to be there for the taking.
And is that a buy and hold? You help them pick 10 stocks and just don't mess with this. I know people that have original Coca-Cola stock certificates. They never sold them, and they have too much. They have too much money now.
Well, you hear those stories are great because it is about long-term buy and hold. So it's somebody that bought a Coca-Cola stock certificate in 1920 and they put it in their shelf and they forgot about it 100 years later. Right. So you hear those stories all the time. The only problem with that is if it's not Coca-Cola and it's the beverage company that went under in 1927, that's not going to be
a lot of them
for you.
That's right. And car companies
it kind of comes back. Right. Yeah. So the main idea is diversification. So you don't want just Coke. You want a number of stocks. When you do an all global dimensional portfolio, you're going to have about 12,000 stocks in your portfolio.
Got it. 12.
So the greater number of stocks is going to minimize that individual stock risk that comes with a Coca-Cola, and that's going to be mean that your compound returns are going to be better over time by minimizing the ups and downs and the volatility that comes from individual stocks. So, again, I'll go back to one quick comment that Merton Miller, when I had my first interview at Dimensional, he was one of the Nobel Prize winners. He was interviewing me. He was sat at the lunch table and he said, 3 things are going to make you a great investor. First is cost matter, so minimize your costs. Second is diversification is your buddy, so always stay as diversified as possible. And third, markets work. So recognize that markets reflect prices, reflect information in the price, and don't try to outguess it. Don't try to come in and out of the market. Stay disciplined and stay in the market, and you can be fine. So if you use those 3, simple concepts, you've got a great chance to have an amazing investment outcome over many, many years.
So a lot of people have done that with tech stocks, heavy concentration, specifically the Magnificent 7, which might not be so magnificent towards the end of the decade, depending on what happens with AI and
Right.
emerging players. Yeah, what are your thoughts on that? Because many of them got advice to diversify, and others just stuck with tech, and it's almost like, Bitcoin. They made too much money.
Yeah. There's always going to be the behavioral aspect to investing. So,
Is that part,
the
is that
Max
part of the
7 reminds
emotional
me-
behavior stuff?
part of the emotional behavior.
Yeah.
It reminds me of the 1995.
I think I'm having it right now.
Yeah. Well, the S&P 500 from 95 to 99 over a 5-year period did 28% per year for those 5 years, from 95 to 99.
Wow.
And its historical return is 10%.
Yeah.
And sure enough, people during those periods of time, I remember this, people say, well, you don't need to invest anywhere else. You don't need to invest globally. You don't need to be invested in small. You just go with S&P 500. That's fine.
Yep.
And the following 10 years, actually from 2000 to 2010, the S&P was flat. And a globally invested portfolio ended up, I think, at 8 or 9 or 10%. So you have to be very, very careful of capturing onto the emotion of the day and what the headline is. And the Mag 7, certainly was the headline last year and probably a little bit before that. But those types of concentrated stock portfolios kind of come in and out of favor, and they go up and down. So again,
Yep.
Try to avoid emotion, try to avoid reading, reacting to something you read, and just, diversify and keep your costs low and stay in the market.
Yeah. Dave, thank you for being on today. Before we go real quick, you got a quick personal reboot story? You've been through a lot. What's been your biggest challenge?
I would say, looking back at my career and coming out of basketball and into finance, as a basketball player, you're a big name and you're this athlete and people know you. And
fans.
Fans. I can remember being in a bar somewhere in New York one time and somebody said to me, he said, you used to be Dave Butler. And I said, no, I'm still Dave Butler. And I think that was sort of emblematic of just, I think, that change. So when you change your career, you reboot, you change go in a different direction, you've built up a lot of credibility in one area, and then you almost have to restart. And you have to recognize that there's going to be a little bit of an ego kind of bash and a little bit of a readjustment in terms of kind of your persona and who you are. So, you got to come back to the question, like, who am I? And it's not, I am a basketball player, or I am a CEO or a finance person. I'm Dave Butler. And hopefully, you want to focus on being, confident and comfortable and proud of yourself as a person.
Right.
I mean, I think that's the main thing. So that was a challenge. I can remember back in my mid-20s, late 20s when I shifted to business.
Yeah, it was a good shift. Great stories, Dave. Appreciate you coming on.
All right. Thanks, Dean. Appreciate it.
You got it. You've been listening to Dave Butler on the Reboot Chronicles. This is Dean Tobias. Please share this episode with someone you think it needs. A lot of great advice in here. And also listen, subscribe, watch wherever you get your podcast, or at rebootchronicles.com.